Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with Annabelle Droulers.
Our top stories. Asian stocks off to a muted start as investors await key U.S. inflation data that could impact the pace of Fed rate cuts.
Yep, and onshore Chinese shares in focus with retail investors continuing to fuel the rally, and that's despite concerns of overheating in the market. AI chipmaker Cambricon warning of trading risks after its stock more than doubled in a month.
Also ahead, China's intense food delivery price war putting Alibaba under the spotlight ahead of earnings that are due later.
And we speak exclusively with the BSP governor, Remolona, as he signals the Philippines may be close to wrapping up its easing cycle.
All right, we're wrapping up the end of the trading week. It's also the last day of trading for August in the session today, but actually we're looking fairly muted as we kick off Asian equities this morning. I mean, overnight it was actually a very solid session for the S&P 500, for instance, fresh record for that index. We had GDP data, for instance, showing the U.S. consumer looking fairly resilient, but not really translating into the session so far this morning. You've got that gauge fairly flat right now, and you're really not seeing too much movement in really any asset class. Stocks, bonds, FX, it's all looking fairly steady this morning. It is that big question, though, of course. You've got that more continued hype around US stocks. You saw, for instance, Nvidia managing to pare its losses. We had some more price target upgrades to that stock. But the session today also very much likely to be directed by Chinese sentiment. And are those signs of overheating continuing to come through? But let's take a look at Chinese equities ahead of the open here, what we're seeing in futures, for instance, because we even had a warning from Cambricon, which, of course, has been sort of it's the AI chip designer in China, but it has been really one of the big beneficiaries as Nvidia or investors look for the next Nvidia inside mainland China. But they actually put out a warning about the trading risks, saying it's really not starting to address the fundamentals of the stock. What else we're tracking, though, is a note we had from Morgan Stanley, for instance. Again, they've been looking at whether there are those signs of overheating appearing. They're saying, yes, they're starting to appear sporadically. Some of the factors they're watching, onshore bond yields, any policy catalysts, for instance, and whether the mainland government will be forced to intervene to stabilize the market. What else they're watching, of course, is earnings. And if you take a look at this terminal chart, for instance, it is a major day for Chinese earnings. We've got a combined $3 trillion of market cap reporting. But if there's one really to watch, and one that I'm going to be watching very closely, it's Alibaba, given that you've had a lot of competition that's come through, even this week with Meituan numbers, for instance, really reflecting the intense competition around the food delivery space, and that is showing up in price targets. Because if you take a look at how they've really been slashed over the last 3 months, I mean, for instance, Meituan, for instance, really taking the brunt of this, but that's a 26% cut to the price target. You're looking at JD, for instance, around 22%. And even Meituan, or Alibaba rather, still down 11%. And analysts are saying there could be more to come. So that's really on the earnings front. On the data front, though, if you take a look at this chart, it's really that direction, what we get for the Fed's preferred inflation gauge due later. PCE data, or the core reading, is expected to tick up. What does that tell us, Yvonne, about where the Fed goes with its easing cycle?
Yeah, because, everyone's been concerned about tariff pass-through, but we really haven't quite seen that yet. It's more about shelter and maybe even services inflation this time around, according to Anna Wong from Bloomberg Economics. That may lead to maybe more of a punchier print, but certainly that does lead to a lot of questions and potentially complicate the Fed's equation here on when to actually start cutting rates again, right? So certainly that's one of the big focus here today for the macro traders out there as well. But as you talk about this China rally, right? I mean, the fact that Cambricon itself, it's not just some sell-side analyst saying chill. It's a company saying chill. You got to wonder, is this rally going a bit too far?
Yeah, exactly. I mean, exactly. This has been really the big beneficiary, and they're saying we don't actually have even any new products coming out. Any reports on that in local media are false.
Yeah.
So they're really, I guess, trying to temper that expectation, and I guess it's going to be really one of the big companies to watch in the session today.
Yeah, and it really kind of lots of questions about this fierce rotation that we're seeing, right? This significant pullback we're seeing in southbound flows, right? Record net selling that we saw yesterday on the Stock Connect in some ways, and really kind of mainland investors sticking domestically right now. I gotta wonder, is that going to be something that's more sustainable here moving forward? As you say, people are start buying into the whole tech innovation sort of trend. But yeah, Alibaba might be the next sort of catalyst there, right? If they could actually say something about how much they're willing to spend in this fierce, irrational competition.
Yeah, I don't think it's just sort of that backward-looking picture, you know, what kind of losses. I mean, we are expecting a loss in the local service group, for instance, and that's more like the food delivery side of the business. It's what they signal about their intention of how much they're willing to stake out their ground in this territory. But there are analysts like JP Morgan, for instance, saying that out of the three, JD, Meituan and Alibaba, Alibaba's actually the one that's best positioned for it. So Alibaba, of course, but the banks as well.
They got the deeper pockets, right?
Yeah.
That certainly is maybe the benefit there. We'll talk a little more about that, but obviously we've got to talk about the Philippines as well with a rate cut yesterday.
Yes, that's right. So they're saying that maybe we've got space for one more cut. A question, of course, when that cut could come. I mean, they've already signaled, for instance, they're in a Goldilocks environment. So do they need one more cut? But of course, we can get into all the details now because the Philippine Central Bank, as we said, could be nearing the end of its easing cycle. But here to discuss it with us this morning is Governor Remolona, joining us exclusively from Manila. So thanks very much for joining us again this morning, Governor. And I want to get your perspective here because you said yesterday there is space for one more cut. You've got 2 meetings left for this year, one in October, one in December. Which one is more likely, do you think, for the cut, if it comes?
I think we've reached our sweet spot for inflation as well as for output growth. If the numbers stay the way they are, then we won't need another rate cut. But there are signs of weakness, Yvonne. For example, the Purchasing Managers Index, which is a good index in times of uncertainty, that indicates weakness. So if that weakness materializes, then there's room for one more rate cut.
What do you think another cut would accomplish then, Governor? When you mentioned we're already at a Goldilocks sort of neutral rate or near there.
Yes. The Goldilocks rate can change. It's roughly the trend growth rate of the economy, and that could change. So if there's signs of weak demand, especially, then a rate cut will help.
And which factors are you looking at more closely? Are you looking at external factors? Of course, trade risks or tariffs risks start to come into the equation, or is it domestic?
Mainly trade factors. So far, our exports are doing well, but there are risks that our exports could decline. So that's one of the factors we worry about.
And Governor, some have actually pointed out that if you see a possible terminal rate at 4.75%, that's still historically high compared to what we saw during the pandemic low of 2% to even the end of 2019, which is, I believe, around 4%. Is it premature to maybe call the end of this easing cycle when we really quite haven't seen the impact of tariffs on the economy just yet?
No, we haven't. That's a big source of uncertainty. I think, of course, during the pandemic, we had to keep rates very, very low. But given what's been going on since then, I think a real interest rate, in other words, an interest rate that includes expectations of inflation, 4% nominal is a bit low. The real rate we're looking at is more like 3%. 2% actually.
So how long then do you take to monitor that pass-through impact from tariffs? What does this cycle actually look like to you in terms of length? And if you are expecting maybe to stay steady, how long do you expect to stand pat as well?
Well, we thought there would be more clarity by now, and that hasn't happened. We're still in the middle of negotiations. So we have to see.
Do you think that we could, you would stay on hold for most of next year, Governor?
Say that again?
If you were to hold things steady, how long could you hold those rates steady? For most of 2026, you think? Okay, I think we lost track of the governor there. Some technical glitches there. We'll try to work that out. But certainly he says there are still a lot of lingering factors and things that they might be looking at, right? Whether, how U.S. tariffs are really going to impact the economy. And of course, domestically as well. But certainly what we're seeing he says it's still not quite certain right now how the external picture is going to be.
Exactly. Still trying to monitor that pass-through impact from tariffs. And he said there are still negotiations that are ongoing as well. But we're going to try and reestablish our hope with the governor and get more perspective on that. But, of course, coming up as well.
Yeah, still ahead, we're going to talk a little bit more about how Taiwanese banks are doing. We're talking about Cathay United Bank's global business strategy, an exclusive chat with their executive vice president and head of international banking, Benny Miao. And, of course, we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show. All right, I think we fixed the gremlins here, and let's bring back the BSP Governor, Remolona there, joining us exclusively from Manila. Governor, hope you can hear us now. And certainly, we want to pick up the conversation of where you mentioned that you might be able to stay on pause for some time as, of course, you assess the impacts of tariffs and the like. But if you were to hold, are you expected to hold for much of next year? Do you have some sort of time frame in mind?
The time frame we're looking at is 1 year. So if we want to hold, we'll hold for, if the data for the outlook stays the same, then we'll hold for the rest of the year.
And so, okay, so you can see then the BSP maybe perhaps not standing pat going through basically into 2027, it seems. Going to more of the domestic issues as well, I mean,
yes.
Barclays, for instance, is still seeing that there's more room for the BSP to cut rates. And one of the areas that they're looking at is the impact of the government move to halt rice imports. Which factors are you watching in particular?
Well, electricity rates is the biggest risk. And then food prices is probably the second biggest risk. Now, these are supply side factors. We can't do anything directly to the supply side, but the spillover effects from those supply shocks we can somehow mitigate with monetary policy.
What about remittance growth? Do you expect things to slow, just given the fact that there are imminent taxes from the U.S. now?
We don't know. We really don't know what's going on that side. But for now, we expect remittance flows to remain stable as they have been for years.
In terms of the currency, I mean, we've seen some moves in the Philippine peso following the decision or the meeting yesterday. What's your outlook for where it trades from here, especially with a possible Fed cut on the horizon?
We don't target the exchange rate. We just try to keep it stable. So far this year, the peso has appreciated against the U.S. dollar, but that's not by design. That's just what the market is doing.
Does that give you a bit more of a buffer then, if you need to cut rates later on this year as well, or if you need to?
A tiny bit. We don't think we need to move in lockstep with the Fed, but yes, it helps, I think.
What's your outlook then around inflation over the remainder of this year?
We think we focus on 2026. We think it's going to be 3.3%, and then 3.4% in 2027. For this year, maybe below 2% for the rest for this year. For 2025.
There's been some debate about whether the BSP should be considering to switch their inflation to maybe a specific number, right? A target versus some sort of range.
Yes.
Can you maybe chime on this debate a little bit here? And when do you think that could be implemented?
I think the way we do it now is not communicated well. I think instead of saying we have a target range, we should say 3% plus or minus 1%. Because the way we do it now, it's as if 3.9% is just as good as 3%, which it's not. We like 3% better than 3.9.
Governor, I want to just get your view on this one. I mean, you've said there's space for one more rate cut this year, but you're also seeming to sort of really maybe back away from that a little bit. So in terms of, the likelihood of one more cut this year, what sort of percentage are you putting on that? Is it a 30% chance of one more cut this year, 40, 50?
I wish I could tell you, Annabelle. It's going to depend on the data, as usual.
Mm-hmm. All right, Governor, we have to leave it there, but thank you so much for dealing with some of the technical glitches for us there. Remolona, Governor of the Philippine Central Bank, BSP, joining us there. We got to talk about this renminbi fix because it's once again a pretty strong one right now. So we're talking about 7.1030. This was stronger than what the analysts had expected, and it's signs of the PBOC maybe nudging towards a stronger currency. So that fix is probably the biggest that we've seen the most since September. So certainly, is this a sign of them maybe steering away from this sort of FX policy of keeping a stable currency? There's a whole narrative behind now that they're looking to maybe, a gradual appreciation to help with the economic recovery and also to help with this equity rally too, Bo.
Yeah, and actually that's sort of been playing as well into some trading recommendations, for instance, because Citi's saying that they're actually recommending a bullish yuan trade on these expectations around appreciation. So that they're actually looking at some positive equity momentum as well off the back of that too. But let's get more on the markets. Bring in Bloomberg's executive editor for Asia markets, Paul Dobson, joining us from Singapore as well. Our China correspondent, Min Lo, also joining us from Beijing. But we will kick off with you, Paul, and take a look at really where the direction of trading has gone, because yesterday it was that big story of pulling back from Hong Kong into mainland equities. Is that something that we should expect to continue? Is it sort of a normal pace as well? I mean, what's your take?
Well, I think that yesterday was pretty extraordinary because of the move that we saw in Meituan and the other platform companies, that really big shock from the earnings getting absolutely pummeled by that competition in the food delivery sector. So maybe there was a little bit of a one-off allergic reaction there. But I do think that in general, it feels like the mainland markets have the edge at the moment, and that's where more of the money is starting to go as well. So there's a little bit of a push and a bit of a pull as well. Interesting debates going on this morning. More people talking about, is this too much of a bubble? Is this getting overheated? And of course, Cambricon itself putting out a little bit of a warning about its valuations too. But on the other hand, we have some strategists who are saying we're only just getting started. There's so much money still sitting on the sidelines here. There's so much money tied up in bonds. There's so much in savings accounts. That could roll back into the equities and keep this going for a good long while from where we are at the moment. So, maybe the pace can moderate. But it certainly seems like there are reasons for people to still believe in this rally and believe that maybe the mainland markets where they've been cheaper until recently might have a chance of showing a better performance than those in Hong Kong.
Min, I'll bring you in. This whole Cambricon warning, I mean, the company itself is saying that the fact that the stock has doubled in a month is kind of far from its fundamentals here right now. What more do we hear?
Yeah, it's been a really impressive rally, right? 134% in the past month alone. It's about 17 times faster than the pace of the rally that we see on the CSI 300. And so the company warned that, as you said, the price moves are detached or have deviated from the company's fundamentals. It also refuted some rumors or information circulating online that the company is launching new products. It says that is not happening, but some of their price moves perhaps had been triggered by Goldman Sachs, for example, raising the price target for this company by 50% on the back of a stronger profit expectation, because Cambricon did provide guidance for its revenue this year. It's about 5 to 7 billion yuan, which is 5 times or so more than the 1.2 billion yuan that we saw last year. But more broadly, it also shows you that investors are perhaps shifting their preference away from those consumer stocks to some of these tech-driven companies as amid this deflationary environment and that trade war, the tech race with the United States. But we did see, though, for example, Nvidia forecasting growth decelerating. We had earnings report from Nauru, a Chinese equipment making company, showing a revenue miss, which was quite unexpected. So possibly we could see the chip sector taking a little bit of a breather today, especially given the profit warning, the warning from Cambricon as well.
Paul, I mean, there's all the question marks around whether this rally in China can extend, but something else that's really going to set the direction for trading, at least in the weeks ahead, is also what we get from the US eco data later, with the Fed's preferred inflation gauge coming out. How important is this for markets? And if we do see sort of an overshoot, undershoot, what does it mean for the Fed?
Yeah, I'm not sure what it means from the Fed, because it does seem like quite a few of the policymakers are kind of already making their decision that September is the time to go for the first cut in this cycle after the pause for most of the year. That being said, obviously inflation is one of the two important inputs that the Fed is monitoring very carefully. It's worried about the jobs data, yes, but it doesn't want to see inflation too high and too sticky. It would much rather see it moderate. Forecast is that the core CPI, which is the Fed's preferred gauge, is going to increase a little bit, partly driven by services, though. And what people will really be looking for is how much is that pass-through of the tariff costs going to come through into inflation. I kind of feel like, with the market expecting a little bit of a beat already, but the market quite well priced for the Fed to begin cutting in September, if we have a strong beat or a strong miss, maybe, kind of like the expectations and the positioning kind of cancel each other out to a certain extent, and that leaves the market not too much different from where we are. But what I would say longer term is, if you're thinking about what we saw in the GDP data, for example, overnight, are you thinking about the fact that the US does have a very stimulative economic policy in place, and the Fed might be cutting as well, then there's few reasons to be really fearful about what's going on in the equities market at the moment, and more to be looking for further gains there.
Paul, Ming Dobson there, our executive editor for Asia Markets, and our China correspondent, Min Lo, there on what to expect at the open today. Certainly one to watch is Cambricon shares here, and of course the pre-market is looking like this here right now in Hong Kong. We continue to see a bit of a recovery, at least here offshore. We're up about 0.4%, 710.30, of course, for your fix this morning. This is Bloomberg.
We're a few minutes away from the open this morning, and just taking a look at how the pre-market is looking. I mean, you've got some upside, but certainly one stock we're going to watch very closely. It's Cambricon. It's warned of the frenzy we've seen in trading activity, and you can see there the result, Yvonne. Yep,
and maybe that's why we are seeing this fierce rotation, right? Record selling yesterday in terms of these southbound flows. So mainland investors are really kind of flocking back into this A-share market in some ways, and really buying up some of those stocks like Cambricon, right? And that really leads to that normalization of course, this H-share premium. Now, you take a look at how things are looking like now. When we were talking about parity just a few weeks ago, maybe we're getting back to now premiums and that widening once again. The open is next.
Welcome back. You're watching the China Show this morning. We're counting down to the open of markets, and it is a major day for Chinese companies reporting a combined $3 trillion of market cap, but also some of the standouts. I mean, Alibaba, for instance, also watching any signs that frenzy, that overheating, maybe those signals are starting to come through. And even a warning from Cambricon, for instance, you can see there that really it's not justified the amount of trading activity you can see. And as a result, I mean, you can see it there, down 7% so far in pre-market.
Yeah, this market darling flagging this alarm bells here that, hey, chill, everyone, right? 6.8% down to the downside. I mean, we talk about how the stock has doubled in a month, so we're just slightly coming off that here right now. But certainly one thing to watch when it comes to some of the southbound flows here as well. Does that actually lead to more of a rotation back into Hong Kong? At least we're seeing a little bit of a recovery there in the Hang Seng here today. But yes, record net selling yesterday when it came to mainland investors buying up some of these Hong Kong stocks. Is this a sign of a trend, or maybe something that, I don't know. Are we starting signs of overheating, right? Morgan Stanley's Laura Wang came up with an interesting note, right? Sporadic but not yet prevalent is how she's framing it in terms of the overbought signals that we're seeing across these Chinese markets. Everything you look at when it comes to, margin trading over a percentage of turnover, for example, that's approaching 2024 levels right now. But so not as prevalent just yet, but certainly we'll talk about the signposts that she's going to be looking out for in the coming months or so. But here you go. We are seeing when it comes to onshore, slight downside in the CSI 300, but we're still around that 4,450 level here right now. We're still watching Shenzhen, which has been on fire as well. That's slightly to the downside here today. And bonds are actually slightly bid up here this morning. We're seeing the 30-year yield down some 1%. We're still around that 2% level, of course, as well. So there you go. That's what's going on. We are seeing some of these major, like Huichao is doing quite well here today. Medeo Group, there you go. Cambricon is down some 6%. So that might be a bit of a drag overall in some of the starboard here today. We'll see how that fares for the rest of the day. But yes, Alibaba is the next thing to watch, right? Because after what I think one analyst said, the blood that was in the water, what Meituan laid out there in terms of what the outlook's going to look like in the food delivery space. It's really up to Alibaba now to maybe give a little bit more hints on what it's going to look like. How are they looking in terms of spending? Are they willing to continue to burn cash in this here fierce, irrational competition, as Meituan calls it as well? Hang Seng is up some 0.4%. HS Tech is flat here right now-ish, right? So Meituan is still down after we saw quite a bit of a steep drop of 10% or more during the session yesterday as well. Alibaba, though, slight gains there, and Baidu seems to be the standout out of the big ones here. We're up at 1.5%. Take a look at the renminbi, though, 712.80, right? So we're seeing quite a massive move here. Maybe we're getting closer to the 710 levels. But another fix that was quite strong from the PBOC. There's a lot of lingering talks of what this means. Is the PBOC favoring a little bit more of a gradual appreciation in the currency here as they want to help with this economic recovery, as they want to build and fuel more inflows into this equity market? And is it enough to show you that there's a change in the FX policy? Because up until now, it seems like they have been preferring a little bit more of a stable currency in the face, of course, of U.S.-China trade tensions. But now that it has cooled down, we'll see, right? But you take a look at how the renminbi is against the basket, though, that's still lower. So maybe there's still a bit of a buffer there in some ways. There you go. Watching, of course, when it comes to earnings. So Alibaba certainly is one. That might be overshadowing what's going on, which is the banks, right? Because all of the big ones are going to be reporting later on today. So the likes of ICBC, Bank of China, AgBank, CCB as well. They're gaining here. We're going to have a great guest from Yvonne coming up talking about the whole dividend play and where things stand here right now. Of course, banks were the first to really kind of lead this rally, but that seems to be now taken up by tech in particular here. But yes, certainly Bloomberg Intelligence says we might be seeing single digits when it comes to some of these earnings growth of some of these big banks as well, so certainly one to watch. Anyways, I talked about signposts. I'm going to tell you now. What is Laura Wang and her team at Morgan Stanley looking at moving forward, right, on potential catalysts and potential things that could actually derail this rally, right? So earnings certainly is one. Onshore bond yields, if we continue to see this melt up or melt down when it comes to bond yields, policy catalysts there, mind the typo, my bad there, but government intervention also, right? We saw signs, possibly, we can't confirm, but there's a lot of chatter there about brokerages and how they're, limiting purchases and talking about raising those margin deposits. And also when it comes to credit cards there, where banks are telling people, don't get a credit card just to buy stocks. Maybe there's some slow signs of, some intervention there. We'll see.
Yeah, I mean, it is, as you said, it's a major, major day for earnings, and this is really going to be something that's going to give us a very good temperature check. I mean, we can take a look. I thought we'd gone sort of as far as I'd seen really with logos earlier this week, but this really puts it in perspective just how many earnings are coming up in the session today. You mentioned the mega banks. I mean, Alibaba, of course, is going to be really one to watch. BYD as well, the health of their overseas expansion, how they're also faring against their own competitors, but a major, major day. As we said, $3 trillion of market cap alone reporting this Friday.
Yeah, I have to correct. There was no typo. Sorry.
I was going to say something. I spent the whole time looking at that graphic, today. Trying to figure it out.
I'm sorry. I thought catalyst was spelled wrong. It looked weird when I looked at it for the first time. My bad. Okay. Of course, Alibaba now. Obviously, there's a lot hanging here, right? You talk about that big number of 3.2 trillion in terms of market cap. I think Alibaba is making a big chunk of that, right? So under scrutiny, as it's a consumer business, particularly when it comes to food delivery, there's a bruising price war that's really hit the rivals. We saw that with Meituan. JD.com as well. Traders will also be watching for its AI investments and whether those are starting to pay off. Let's bring in our team from Bloomberg Intelligence, our senior analyst Robert Lee here in the studio, also Catherine Lim in Singapore. Catherine, I'll start with you because it seems like anything they say about AI is going to be overshadowed by what's going on in food delivery here right now. And after what we heard from Meituan, should we expect Alibaba to follow suit?
Well, I'll put it this way. Meituan has told us how severe the competition was from April to June, and they have guided that it's going to get worse from, in the third quarter. So I think Alibaba is likely going to just chip into that because they are a major force in the competition that we are seeing among the three of them. What is interesting is that, Meituan actually highlighted that there may be more e-commerce players coming into the on-demand delivery service market. So they're not alone. The entire battlefield is getting more crowded. And, as we speak right now, today is the seventh lunar day of the 7th month, and it is Chinese Valentine's Day. So I'm seeing so much subsidies and promotions out there when it comes to bubble tea, drinks, food delivery. So great day to announce results.
Yeah, and there are signs, for instance, Alibaba, well, actually they delayed their results as well more than we were expecting, so maybe this is why, but there are signs that Alibaba has more firepower, more willingness to keep this battle going. But how exactly do you see them faring in that pain that we've seen from Meituan, for instance? Is Alibaba actually going to be able to capitalize?
Right. Alibaba still has a very strong Taobao Tmall business. And that's different from your food delivery in a sense that, it is a very cash generative, and they've actually built a dominance from that perspective with the merchants and the suppliers for the discretionary goods. So that's going to take a hit. And don't forget that the company will be reclassifying some of these business into now the overall China e-commerce. So depending on what they actually report for the past few quarters itself, but you're going to see that, the food delivery is likely going to be the least profitable compared to its traditional e-commerce discretionary selling. And, I guess at the end of the day, what we are on the lookout for these e-commerce companies really is that what is the new normal margins for all of their business going forward.
Yep, the new normal in this kind of fierce competition. I'll bring you, Robert, now. There's so much talk about food delivery, but we got to talk about cloud computing. What are we expecting there on that front for Alibaba?
Okay, the focus is more on the AI side of the cloud business because they dominate mainstream cloud and they've been increasing their share within the AI side. So we'll see the top line momentum continue to accelerate. And based on consensus numbers, that should continue through the rest of the year. But the key question, and I don't mean to rain on a parade here, is margins. Because if you cast your mind back last quarter, they actually missed margins. And in common with some of Catherine's comments on the e-commerce side, and as we see in many subsectors of the China tech sector, there's intense competition, a lot of margin pressure, companies competing on price. So I think there is ongoing, at best, the margin remained flattish compared to where it's been in the sort of high single-digit range. There is a risk that the margin disappoints again, given the rampant competition there is at the moment.
Let's just shift a little bit because we were talking about Cambricon earlier as well, that they've had to put out a warning essentially that the frenzy we've seen in the stock is not justified. How do you look at valuing stocks like this that are maybe being considered the next Nvidia in mainland China? Because, not every stock is always having their stock price attached to their fundamentals.
Okay, again, for people with a long enough memory in the China market, there's fantastic growth opportunities in this part of the world. There's some very interesting companies, but these markets, not just China, but I think Asia as a whole, they tend to have a very high retail element. There tends to be a lot more volatility than you might see in other more developed markets in other parts of the world. And so you do have a tendency, particularly if you look back to the pre-2008 period, stocks were trading at some, substantial multiples. So it looks like retail investors are coming back. Cambricon is a business which is really interesting, off a very low base, with the support of the state, which is encouraging AI companies to buy locally. So clearly, it's got a tailwind behind it. But you made the comparison, or people have made a comparison with NVIDIA. In broad terms, they're similar businesses, but this is a minnow compared to NVIDIA. If you look at the consensus numbers in US dollar terms, its net profit for this financial year will be $240 million US dollars. Now, that's a substantial increase in what they did last year, and the year before that they were loss-making. But you think of the, I can't remember, tens of billions that NVIDIA's, this is a drop in the ocean. And the valuation it trades on, sure, investors might pay over the odds and wait for the company to grow into the multiples, but I think most people would agree, and as the company has said in its release, there's maybe a little bit of over-exuberance there.
All right, Robert, thank you. Robert Lee there, talking a little bit more about Cambricon and, of course, Alibaba. Our thanks to Catherine Lim on what to expect on the food delivery side of things as well. Coming up, we're going to have Cathay United Bank joining us next to discuss its business strategy and potential expansion plans as well. This is Bloomberg. Looking at some recent earnings that have been hit by, of course, uncertainty over tariffs and the like here. We heard from Caterpillar. Shares slipped after the bell in the U.S. after the firm warned that U.S. tariffs will squeeze margins more than expected. The company now sees a hit of up to $600 million this quarter and as much as $1.8 billion next year. Caterpillar warns its full-year profit margins will land near the bottom of its target range, underscoring the growing cost of tariffs on American manufacturers. Best Buy shares pared back some losses after sounding the alarm that tariffs will continue to cloud its outlook ahead of the holiday season. That caution tempered the news of its first sales increase in more than 3 years and fueled by gaming equipment such as the Nintendo Switch 2 and computer demand. The retailer warns uncertainty around tariffs on China and other suppliers remains a key risk. Costco Shipping's first half net income rose almost 4% to $2.5 billion. It was driven by stronger exports such as EVs and batteries, plus resilient demand in Europe and the U.S. But China's largest container ship operator is warning that uncertainty about tariff policies will continue to pose challenges for its outlook.
Well, we're taking a closer look at the latest trends and supply chain shifts in the region due to those uncertainties Yvonne was just saying there. But our next guest is from Cathay United Bank. The firm provides banking services to major Taiwanese tech firms and supports cross-border business flows in the region. It's a subsidiary of Cathay Financial Holdings, which is one of the largest financial groups in Taiwan. Joining us exclusively from Taipei is their Executive Vice President, Head of International Banking, Benny Miao, joining us. So, Benny, thanks so much for your time this morning. And as Yvonne was just laying out some of the companies that it's facing trade tensions and how they're dealing with those tariff risks. I mean, we just said there as well that you're banking some of the biggest companies in Taiwan and around the region. How are they faring right now with that level of uncertainty, or even as more clarity comes through on tariff rates?
Well, good morning, and thank you very much for having me on, and wish you both a happy Chinese Valentine's Day. Our clients right now went through a period of uncertainty, right, lack of clarity, but as the tariff agreements start to settle, there's a bit more visibility in terms of what they want to do. I could share that our clients actually are taking a bit of a three-prong approach. One is definitely looking at diversifying their supply chain in terms of their upstream suppliers, in terms of where they source, so they have a better way of diversifying and hedging against any potential changes in the tariff rates. Second, they're also changing the markets where they sell to, right? So some of the benefits, I guess the silver lining would be that they are getting new customers approaches from other markets that they previously were not serving. And the third, they're also looking at diversifying their own manufacturing base in terms of not necessarily putting all their eggs in one basket in any particular market, whereby they are spreading around Southeast Asia potentially, given that the tariff rates are relatively about anywhere between 19-20% for most of those countries. So they're usually taking those three-pronged approach. Some clients, actually majority of clients, are all saying that they're talking to their downstream buyers to renegotiate contracts and potentially to agree to some arrangement of how to handle the tariff increases in cost.
How do you see things since Liberation Day, maybe? Maybe give us some context here. Obviously, that was when there was a tremendous amount of uncertainty. And now, as you say, we have tariff level rates for most of this part of the world. How has that impacted flows and what markets that you're looking to expand to, particularly in Southeast Asia, too?
Actually, after Liberation Day, the biggest impact was obviously Vietnam. Right, that one was a surprising number in the fours for the four handle, and that pretty much put a stop to any investments and any development that clients were looking at in Vietnam. Once that rate actually got settled down to the 20, then that's where the market actually, basically picked back up, and the clients are now saying, "Oh no, if we're going to continue investing in Vietnam, we're going to maintain that and potentially even increase that, depending on how the other trade flows work out with terms of the other agreements." Right now, the biggest, the biggest X factor is China. Right, you're currently at the 30, and we're waiting till November 10th to see where that settles. But as what we call the T factor comes into play, we don't know what's going to happen with the tariff extension again type of treatment.
So do you see that then the China plus one strategy is still intact? I mean, Vietnam is a market that you've called your second home. Would you still continue that pace of investment in the country?
Oh, absolutely. I think both the China plus one or China plus 1 still continues. If anything, it's accelerating. Even for the Chinese manufacturers themselves, they are also expanding their base outside of China homeland. Vietnam, again, is a market that we're looking very promising. We have high expectations for that growth going to the future, given where the government is sending new policies, the new IFC policies at Da Nang and Ho Chi Minh City. I think it's a market that holds a huge potential for us and for our growth. And not only that, as part of our Cathay Financial Holdings, we also have our sister affiliate companies there in Cathay Life Insurance, Cathay Insurance, which is our P&C insurance company, and we have a joint venture bank, the Indovina Bank there. So it's a pretty big market to have our full Cathay platform there.
And maybe tell us a little bit more. I believe you got approvals to set up branches in markets like India and Japan too, Benny. Can you walk us through kind of what the business strategy is around those markets and how big of expansion are we talking about, and maybe some timeline too?
Timeline, we're looking hopefully within the next 12 months we'll be able to formally announce that we've officially opened the branches within India and Japan. Strategy-wise, in any new market we enter, it's really a three-pronged strategy. The first prong is always servicing our FDI customers going into that market. For example, Japan, not only the Taiwanese, but the other Chinese companies, et cetera, going into Japan, whereby we have one leg that's already secured in a market that we currently are present. So that's one that we want to service. Two is the Japan outbound, going into Southeast Asia. So Japan's a big investor in, say, Laos, big investor in Vietnam and Thailand. So we want to be able to service those customers as well. So Japan going out. And then the third one is more of a longer term play, is where we want to say, well, can we carve out a segment within the local market whereby we feel that we can provide additional services that maybe the local banks or the regional banks within Japan cannot serve. So we try to service that. But the first two are the main strategy points that we look at for every new market we enter.
And so what's sort of the commitment then that you make around headcount? How's your hiring plans looking, and which markets are you most focused on then?
Right now, the biggest headcount increase that we're looking at is Vietnam and Singapore, largely because Vietnam, as I said, is a second home. So we really have a high expectation in terms of our base fundamental business. Second, we also want to increase our technical capabilities in Vietnam. It's a home to over 100 million population, very young population, very high-tech focused. So we really are looking to build a tech hub, so to speak, in Vietnam as well. So our overall headcount increase in Vietnam is going to be quite significant over the next, say, 3 to 5 years. Singapore is another one that we want to grow. Significant headcount is partly because of our private banking business, as well as our core corporate banking because of the regional capabilities. The third one that we're looking at is obviously the Hong Kong and Greater Bay Area headcount between Shenzhen and Hong Kong. So we really feel that there's a huge potential opportunity to really capitalize on that increasing trade flow between Shenzhen and Hong Kong. But in addition, having Hong Kong as a gateway out for China or China Inc., I think it's a great opportunity for us to expedite or facilitate that kind of flow going China plus one out.
Yeah, Benny, what's it going to take to create this sort of hub, as you say? How many people are you actually going to be hiring in the next few years?
Next few years, I think right now our headcount in Hong Kong, for example, is about 150-ish. We're looking to bring that to maybe 200, hopefully by end of next year. Singapore, we're about close to about 180 today. We're probably reaching that over 200 by next year as well. Vietnam, we're looking collectively, we're looking at 200. Probably going to grow that by another 50% or so, including the tech space.
Great. Thank you, Benny. It's great to have you. Thanks so much, and hope you can come back to the program. Benny Miao there, Executive Vice President and Head of International Banking at Cathay United Bank in Taipei. Coming up, we're going to speak exclusively to the Prudential CEO on the outlook for the firm after it saw buoyant first-half demand in key markets in Asia. That's happening in the next hour. This is Bloomberg.
Taking a look at markets this morning, we're about 25 minutes into the session so far, and you are just seeing, overall markets are holding up today, but one sector that's in the red is very much the semiconductor one, and that is after we had a warning from Cambricon. They have been one of the sort of standouts in the AI chip space in China, but saying essentially we've gone too far too fast, and really the stock price is moving away from the fundamentals. So that is also sparking a sell-off across the board. Guotai Junan is another name that we're watching here. You're seeing that stock, for instance, climbing around 15%, but the company has launched virtual asset trading services for Hong Kong investors, and the SOEs are in focus as well.
Yeah, certainly see a big rotation to some of these SOE plays here as well. So we're seeing a decent sort of bid across the likes of the banks, ICBC ahead of its earnings as well, PetroChina, Bank of China, and China Life all rallying here this morning. We have plenty more in the next hour. This is Bloomberg. Sunny skies in Shanghai here today. Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session. And yeah, still looking pretty good here right now, right? We're still tracking, of course, those southbound flows, which, the net selling yesterday was certainly one thing to watch, given that it was record numbers, right? Looks like we're still seeing quite a lot of momentum in this onshore rally here this morning. We're up about 0.5%. But yeah, certainly one to watch as we look down the next sort of event risk up there, which of course is Alibaba earnings.
Yeah, Alibaba earnings really one to track, and also how they're really faring in that competition against JD and Meituan, and who's going to dominate the food delivery space. In the session today as well, aside from earnings, that really big watch on what's happening with the currency, because we had that yuan fix in the last hour, and this is a really strong one. We've seen a series of strong ones, but now it's this big question. What's the PBOC thinking, and are they actually wanting to really change the way they think about the yuan as well and engineer an appreciation higher? Earlier this year it was really kind of, let's keep it steady and stand pat and see how it really goes in the tariff war and tit for tat that we were seeing between Beijing and Washington. Now it seems like they're actually getting really comfortable with the exchange rate, letting it actually appreciate as well, especially when you've had some strength in the exports numbers as well. So that's what's happening with the offshore yuan there. But let's also take a look broadly in the session today, because yes, it's that big focus on China earnings. It's also what's going to happen with the Fed's preferred inflation gauge later today as well. And if that comes in hotter, what does that mean for any chance of the September Fed rate cut? Paul Dobson, though, in the last hour, executive editor for markets, was saying, really don't read into it too much. Really from what we had so far from Fed officials, they're saying they want to cut in September, and the stage is really set. So that's what we're seeing, though, broadly for markets in the session today. And really, as I said, a couple of watch points, data plus what comes through in earnings.
Yeah, we just had Waller come on and spoke too about, he thinks that things are ready for a cut soon too. So certainly, of course, he's one of the candidates, I guess, to maybe replace Jay Powell. So certainly he might say that. But yes, leaning towards more dovish is certainly still the theme that we watch, given, the big take today about the Fed and really what the Trump administration is trying to do to influence it is certainly a really good read out there. But yes, we got to talk about the China rally, as you say, right? It still seems like this Asia market has some momentum behind it. And that's despite what we heard from Cambricon and some of these, the local domestic chip makers are actually falling today, but yet this market is still seeing some green.
Yeah, and actually we've just had this call coming out from Goldman Sachs, and they have actually raised their 12-month target for the CSI 300 to 4,900 from 4,500. So we're actually close right now to the 4,500 mark, but just staying a little bit below that. But 4,900, that's what they're seeing or setting for their 12-month target. And they're looking at a range of different supportive valuation metrics. You've got trend level profit growth in the high single digits, favorable throughout the market positioning. So they're saying that basically, we've got room to go.
Yeah, I think Kendra Lau and Laura Wang might have different views right now. I think Morgan Stanley is saying, look, they are a bit more cautious. They're talking about emerging signs of market overheating. It's sporadic. You're seeing little hints of it here and there, but it's not prevalent just yet. So maybe not like big warning signs, but certainly there's some little hints out there as well. So yeah, please come on the show and talk about it. But then we got to talk about earnings as well. As you mentioned about Alibaba, that's the key thing to watch. Obviously, there is that AI push, but I don't think people are really going to care too much about that this time around.
No, it's really about food delivery space, price wars, and how much they can fend off the competition. I mean, it's really the key thing that's come out of JD, Meituan, and Alibaba, of course. Can they be benefiting from the pain, for instance, that Meituan has seen?
Yeah, I mean, it's the fact that Meituan is talking about pain ahead and maybe even concerns of profitability. Does that actually force and propel Alibaba to go even more aggressive?
Yeah,
in their
exactly. Your loss, my gain.
Yeah.
Maybe we'll see. But let's get a snapshot of how Chinese markets are doing. Let's bring in our Bloomberg managing editor for Asia Equities, Lian Ting Tu, is joining us this morning. So, Lian Ting, I mean, we just sort of heard there these different calls. Goldman Sachs has just boosted their China stock targets. Yvonne was pointing out Morgan Stanley is flagging the risks. But what's going to be the next key to drive the China stock rally, do you think?
Yeah, the next key people are talking about is really the household savings. We're talking about a near record $22 trillion of household savings, and whether that ball of money is going into the Chinese stock market is something that all market participants are watching very closely. We are seeing early signs of retail investors coming into the market. If you look at the account opening data in July, I think we're seeing a 70% jump. But we are also looking at other data points showing that there is definitely not that kind of enthusiasm that we saw in a rally in October last year or previous rallies. And as you guys pointed out, Morgan Stanley and Goldman, they are debating whether the rally has legs. And I think retail investors have gone through all the boom and bust cycles, and they were really burned and scarred a few times. And the earliest I should say a parallel in 2015, still very much fresh on many people's minds. So, that kind of explains why the kind of animal spirits we saw in previous cycles are not really coming in very strongly at this point. So, yeah, I think we are also going to be tracking all sorts of data points to see whether that ball of money is trickling in.
In terms of what we're hearing from regulators, I mean, what do you think is the regulatory stance towards this rally now?
Yeah, I think regulators are very much caught in a bind right now. They really want to curb speculation, but they also want to engineer or foster a healthy or slow bull market. And so far, we have seen measures coming out from regulators to support the market. For example, they have unwound some of the restrictions, including easing short selling rules. But at the same time, we also saw curbs from brokers and fund houses and commercial banks to restrict flows into the stock market. It is not an easy task for regulators to succeed in engineering this bull market. And there's a lot of speculation that big ban curbing measures may not come in before the September 3rd military parade. But after that, we may see some more strong-handed measures. But this time may be slightly different, just because, as I just mentioned earlier, retail investors are actually not storming in right now. So it could possibly make regulators' job a little bit easier this time around.
Yeah, a little bit more stable in that way. Lian Ting, thank you. Lian Ting, too, they're our managing editor for Asia Equities, joining us out of Singapore. We've got some big interviews coming up as well on the China show. We're speaking exclusively with Prudential CEO Anil Wadhwani there, talking a little bit more about the business outlook and side of things, what markets that really they're looking into as well. Mike Ming as well from eFund Management, a PM there, discussing dividend strategy when it comes to onshore and offshore markets there. This is Bloomberg.
Well, we're tracking the insurance sector this morning, and here's what we've seen from some of the industry's biggest companies in the region. China Life's new business value leads the field with 58% growth. Prudential also reported earnings this week, and the metric that it uses, which is new business profit, was up 12% in the first half.
Yeah, joining us exclusively here right now is the Prudential CEO Anil Wadhwani there, and certainly there's been a lot of talk since those earnings came out about the high and premium segment of things, and really that's really driving a lot of their growth here right now. China certainly has been a market that has been coming back and re-emerging here, and certainly, of course, more on their strategy when it comes to expanding in the region. Anil Wadhwani is joining us here in our studios. Anil, it's great to have you here.
It's great to be here.
So, as Bill mentioned, 12% gain in the first half. You have, of course, this 2025 guidance of 10% growth in new business profit. What gives you confidence that you can carry that momentum into the second half?
Yeah, so very pleased, Yvonne, with the set of results that we announced. Double-digit growth across our key metrics, very much in line with the guidance that we had given in the earlier part of the year. And it's been a key inflection point for us in terms of our transformation journey. The free surplus generation was positive, 14%, which goes to underscore the strength of our business model, the capability it has to generate sustainable cash returns for our shareholders over a sustainable period of time. Now, the trajectory that we set for ourselves, as well as the investments that we are making in the growth drivers of the business, gives us high levels of confidence to carry that trajectory into the second half.
What markets do you think are seeing the most growth here right now?
Yeah, I think a key strength, Yvonne, for Prudential is the multi-market growth engine model. And we think about our markets in segments of Greater China, ASEAN, India, and Africa. And given our capital strength, we have an opportunity to grow all these markets. So Greater China markets did very well. Within ASEAN, Indonesia, Hong Kong, Thailand grew their new business profit. India, again, is a phenomenal opportunity for us. And Africa, the Anglophone markets grew north of 20%. And that's, again, something that we are looking to as to how it can match and complement the growth profile in Asia.
And with China, it's been a struggling market for some years, right? But it seems like from a sentiment perspective, things are picking up again. What sort of presence do you think Prudential's going to still have in the mainland when you have rivals like AI that are really widening their footprint there now?
Yeah, so interestingly, we have a phenomenal presence and footprint in China. We are in across 23 branches, over 100 cities.
You have a JV with CITIC?
Joint venture with CITIC, one of the largest state-owned enterprises in China. So the distribution and access is not an issue for us. When we gave the guidance in the early part of the year, double-digit across our key matrix, I had mentioned that you could expect China to grow at high single-digit. And given that China grew 8%, was very much in line with what our key expectation is. I guess the important piece is China continues to be a phenomenal market and a phenomenal opportunity. I mean, if you look at just the expanse of the market, the aging population, over 40% of the population in China is likely to be greater than 60 years by 2045. The healthcare costs, and while they are coming down, they're still at a pretty elevated level as compared to some of the Western markets. So I think there are structural growth drivers in China that will drive growth for the insurance sector for the foreseeable future.
Yeah. How is the competition in that space right now?
I think the competition is obviously quite intense across markets, and China being no exception. Yeah. But I think what we are focused on is the strengths that Prudential brings, right? 180 years almost of presence in multiple markets across the world, great expertise, great knowledge, phenomenal brand, almost a household brand in the markets that we operate in. And as I said, multi-market, multi-channel growth engine model.
It's been well telegraphed, this $1 billion of capabilities investment that you guys have announced as well. Can you tell us a bit more about just the thinking behind it, and can you frame kind of the benefits from these investments?
Yeah, so when we announced a strategy in August 2023, I did mention that we would like to invest $1 billion to modernize Prudential and to make Prudential future ready. And what I meant by that was modernizing our technology, our processes, our capabilities. And we have made some phenomenal progress in that direction, expanding our distribution, setting up our health vertical, focusing on automation and driving better customer experiences. And we are seeing some great results. And a good proof point is the first half results that we delivered this year.
How soon do you think we could see returns, or even more sort of sustained returns?
I would say that you're already seeing the returns, okay, which is illustrated by the results. And as I said, we've only halfway through our transformation journey. And I believe that our execution of the strategy is getting sharper.
I want to get your take also on, there's a trend in the insurance business, or at least asset management, where these sort of external fund managers and alternative investment firms are really kind of getting into the likes of private credit and the like. And it's really kind of transforming the insurance industry in some ways. Does it change how you rethink where you put your investments, or what maybe, which insurers are quite conservative in where they invest, whether it's traditional bonds or IG credit?
Yeah, a good question. Let me answer this in two parts, right? One is we are very pleased to have an internal asset manager. I think the flywheel between insurance and asset management is something that's kind of unique to Prudential. And the more you grow the flows through insurance, the more flows our asset management company gets. So that integrated model and how we can bring the manufacturing capabilities of our asset management company and complement that with insurance and create products for our customers, specifically in the high net worth segment, I think is a distinct opportunity. On your question on private credit, our balance sheet is very conservatively positioned. So private assets are relatively a small part. But that speaks to the opportunity. And I think there is opportunity on a selective basis for us to grow our exposure to some of the private assets.
Yeah, your CFO mentioned about stepping up those allocations into the private space. I believe currently it's about 1 to 2% of your investment profile. Maybe that could be bumped up to 5 to 10.
That's correct.
Can you give us a bit of a timeline on when that could happen?
I think insurance, if you look at it, Yvonne, they are long-term business. We are a long-term business, right? The policies that we write are 5, 10, 20 years long. And then when you look at the private asset category, it kind of matches with that time duration, right? Specifically when you look at infrastructure, I guess these investments complement just the long-term nature of our insurance business.
What is the breakdown that you're looking at? I mean, you mentioned infrastructure. Is it private credit? Is it private equities? I mean, what is it that you
I think it would be primarily infrastructure and private credit.
Okay. Okay. Obviously, there's a lot of talk about Eastspring, this deal. It's been reported that it's been on and off. Can you tell us a bit more about any updates on why there's been a holdup?
Yeah, I wouldn't speak to market speculation. Eastspring is an integral part of Prudential. As I said, we like the flywheel between insurance and asset management. I think we are focused on three things: driving investment performance, expanding our third-party distribution, and driving efficiencies, which I believe there is significant opportunity in. And as I said, I'm looking forward to harnessing the manufacturing capabilities to provide innovative solutions to our customers.
What is sort of the long-term thinking on the asset management arm, though? Is it more about selling a stake? Is it more about partnerships? Are there what are the options that you're considering right now?
I think we have some distinct strengths when you look at Eastspring in terms of fixed income and equities when it comes to the Asian context. What we're looking for is an opportunity to be able to beef up those capabilities, and that will then allow us to deploy the flows from the life business in a more effective manner.
Before I let you go, you could talk about India. Certainly, there's a lot there with the ICBC IPO. Also, you're applying for a standalone health license with partner there, too. What sort of progress has it made so far on that front?
So India is a strategic market for us. We're very happy with our joint venture relationship with ICBC. And I think just kind of given the structural opportunities that India has on offer, we want to do more in the Indian market. You're absolutely right. We are very much on track to launch our standalone health business in India. The out-of-pocket expenses in India are north of 50%. So it just kind of speaks to the wallet size and the opportunity there. And you're right, we're also looking to the potential IPO of our asset management business in India.
All right, Anil, it's great to have you. Anil Wadhwani there, CEO at Prudential, joining us here in our studios. Belle.
Great interview, yeah, Yvonne there. Well, just as you've been speaking, we've actually had an NDRC briefing underway this hour, and some of the interesting headlines that have come out so far relate to AI. Of course, the story today is Cambricon, for instance, the AI chip designer warning that the stock price is starting to detach from the fundamentals. But actually, the NDRC briefing has touched on this perhaps, but they're talking about firmly avoiding disorderly competition in AI development. They're also looking at promoting data factor sharing for AI and also promoting so-called orderly human capital circulation for AI as well. But just some of the headlines and highlights out of that briefing so far from the NDRC, you can see here Chinese stocks are moving high. We've got the CSI 300 on track for its highest level since March 2022. More ahead, this is Bloomberg.
Well, Chinese President Xi Jinping's closest international allies, including the leaders of Russia and India, are gathering in Tianjin this weekend for China's biggest diplomatic event of the year. The Shanghai Cooperation Organization Leaders Summit will be followed next week by a rare military parade in Beijing. Let's cross over there to our Chief North Asia correspondent, Stephen Engel, joining us from the Chinese capital right now. And Steve, what are you looking for from the SCO in particular this time?
Well, this is likely to be the biggest SCO ever, and it was formed about 24 years ago by Beijing and other nations, including many of the Central Asian former Soviet republics like Uzbekistan, Tajikistan, Kazakhstan, and others, as well as Russia and India. 10 members now, Belarus adding to make it a round 10. But there are also other countries that are observers and partners like Saudi Arabia, Mongolia. We're going to have the Turkish president here as well, Erdogan. We're going to have the Prime Minister of Malaysia, the President of Indonesia. Iranian leader is going to be here as well. So it's really shaping up to be the largest SCO to date because, again, Xi Jinping is the host. Of course, we're going to be looking at the dynamic between Xi Jinping and Vladimir Putin. That's front and center. How are they going to build out their no-limits partnership going forward? But more intriguing to me is going to be the Modi-Xi dynamic, the Modi-Putin dynamic, at a time, of course, when the United States has been kind of lambasting New Delhi for its purchases of Russian oil and then refining it and repackaging it. So the U.S., of course, has put an extra 25% tariff on Indian goods because of that, on top of the reciprocal tariffs of 25%, sort of pushing, if you will, New Delhi more towards a cooperative arrangement with Beijing, if not Moscow as well. So there's a lot at stake, obviously, in this time of increased geopolitical pressure from the United States on the trade front. So how much weight can the SCO and its 26 nations and observers really find a coalesced message coming from Tianjin this weekend?
Yeah, I think that's been sort of one of the challenges so far, is articulating a vision beyond just pushing back on so-called a US unipolar world. I mean, are they going to be able to do that? Is that going to be a focus, do you think, of this summit? And how as well does that set us up for the military parade next week?
Yes, well, the military parade will be just sort of a show of hardware from the Chinese. They have definitely modernized their military, the PLA, if not revamped it, with a lot of senior officer purges, but also advanced weaponry and drones and intercontinental ballistic missiles. So we'll see all that coming on Wednesday. But at the SCO, it's really going to be fascinating to see just how far the rapprochement between India and China has gone. There was this letter that we have learned, Bloomberg News in this scoop, that was sent from Xi Jinping to his counterpart in New Delhi back in March, kind of testing the waters to see if New Delhi was willing to basically bridge their differences at a time when we were already hearing that the Trump administration was going to be more protectionist and was going to be launching essentially a trade war on many different fronts. And I guess New Delhi was quite taken aback and taken by surprise by this 50% tariff, which sort of pushed, if you will, Modi closer to Beijing. So I want to hear what both of those leaders are saying about this new relationship and what does it mean. Keep in mind, the Pakistani leader is going to be here as well, so that makes it even more intriguing. But Chinese officials here have already been dubbing it a dragon-elephant tango. That's a euphemism for great relationship building, obviously, between those two of the world's, the two most populous nations.
Yeah, the great stuff, Steve. I mean, really looking forward to your reporting over the coming days. That's our Chief North Asia correspondent, Stephen Engel, there in Beijing. And just taking a look at some of the movers in the session as well so far, because lots of earnings, of course. We've been talking about $3 trillion in market cap reporting today, but some of those as well that have already posted their numbers. Casino operator, for instance, SJM, and you're seeing a very sharp drop there, but EBITDA fell short of expectations. We've also got Gree Electric, for instance, their first half net income missed as well. Foshan Haitan, though, is looking a little bit better because analysts are seeing a core or a solid core business for it. And Li Auto as well, that's in the green there because you're seeing AI efforts essentially from the company, so overshadowing or investors looking at that as opposed to some weak results and price target cuts as well. We'll have plenty more ahead. This is Bloomberg.
$11:29 a.m. in Tokyo. Japanese markets heading to that lunch break here right now, and we are seeing a bit of downside when it comes to stocks there this morning. The Nikkei is down about 0.5%. Same goes for the topics as well. The yen is just below that 147 level, but certainly a lot of action happened in that two-year yield yesterday after we saw the weakest demand in that auction since 2009. So certainly there's still a lot of traders that are betting that BOJ is going to have to hike rates pretty soon.
Yep, certainly keeping a close watch on that, but also taking a look at what's happening across Asian markets this morning. And we're actually looking fairly steady so far. Interesting because overnight we actually saw the S&P 500 hitting a fresh record high. We had GDP, for instance, or GDP data that showed consumers are kind of holding up right now in the economy. And big question marks, of course, where we go with the Fed's preferred inflation gauge on Friday. And if that manages to derail any expectations we have already kind of baked in right now for a Fed rate cut in September. But in terms of what we're watching in the session today, I mean, there's a couple of different key themes. Earnings, of course, is really standing out. Can't say it enough. $3 trillion of market cap in China is reporting today. Market cap in terms of the number of companies reporting. Lots of different ones we're focusing on, but Alibaba, I think, is one of the big standouts.
Yeah, Alibaba certainly is the one. I mean, obviously, given all the pain that we're seeing in the food delivery space here right now. And then again, are we going to see that sort of earnings momentum that can keep this rally going? That still is sort of a question mark as we're more than halfway through the earnings season here right now. Another sector that we're watching today are Chinese banks. The Big Four reporting earnings on Friday. And for what to expect, let's bring in our Bloomberg Intelligence senior analyst, Francis Chan. He joins us now. Francis, what are you expecting this time around for the Chinese banks?
Well, I think you don't expect a lot of growth from this sector. This sector is still undergoing the severe net interest margin pressure. And one of the positives from the industry trend will be still relatively steady asset quality, as reflected by the sectoral data from the regulator. So we are looking for maybe more or less flat earnings for the biggest banks, maybe relative to last year's numbers. And of course, we hope for some improvement, especially in net interest margins. But loan growth has been meeting with really muted demand over the past 3 months, according to the social financing data. And we will look forward for some of the guidance from management tonight.
What do you think in terms of the trading activity? Because we have seen Chinese bank stocks rising, but at the same time, if you take a look at options activity, for instance, it's bearish wages that are dominating. So what happens, do you think, post the numbers?
Well, if you try to look at for instance, over the past 18 to 19 months of China bank stocks rally in Hong Kong, very obviously, it has been partly driven by the purchases from the national team and many of the southbound flows. When China is not, when on the mainland, in the mainland market, the interest rates and asset yields are getting lower and lower. And we then see a lot of flows to Hong Kong. I reckon much of those would be from the Chinese market. And with high volume, obviously, that there will be more option activities. And for the foreign investors, it's also a very good playground if they don't want to take part in the underlying market.
Francis, the big reason why we've seen bank stocks do quite well is the dividend play, right? How intact is that story still for some of these lenders?
These big banks, for instance, the big four state banks in China, they will still pay out 1/3 of their profits as dividends. And I don't see that will change. And if there will be any slightly decline in their net profits, they may adjust their payout ratio modestly to keep the payout ratio to pay the dividend per share steady or even higher and higher. So that story should still be pretty much intact.
All right. Francis, thank you. Our Bloomberg Intelligence senior analyst, Francis Chan, joining us in Hong Kong on what to expect for some of these bank earnings here today. Let's bring in Mike Ming now, portfolio manager at eFund Management. He focuses, of course, on the whole dividend play in this Chinese market. And Mike, we talk about how it really was, the dividend strategies that really was the first to really drive this equity rally in China. That maybe we've still been so in the spotlight by the likes of tech of late. But do you still think that this whole dividend trade is intact, and why?
My pleasure to be here. Thanks for having me. This is Mike Ming from eFund Management. So good question. For the past 2 years, the dividend strategy worked pretty well. So, but it was usually not that case because, for example, for the mutual fund managers, they always love growth opportunities. They always believe in the bright futures of the stories. But why was that? So I changed for the past. First of all, I would say for the past 2 years, the economies remained pretty soft. So in that sense, there were now many growth opportunities in those TMT and the new energy sectors. But meanwhile, the dividend names were pretty good in terms of the earning growth, though low at single digit to low teens. So another reason was that the PB ratio for the dividends names were at a historical low. For the bank sectors, it was even below 0.5. So in that sense, the re-rating opportunities were for those dividend names were pretty high. Therefore, there were some mutual fund managers who always abandoned the banks, coming back for the banks. That was the reason why the dividend strategy was working pretty well.
So,
but going forward,
so Mike,
going forward, it really depends on how long you look at it. So if you look at it for a long-term investment, I would say definitely dividend is still going to perform pretty well because of the low rate environment. The T-bond fell below 2%. But in the short term, if you look at the onshore equity market rally, I would say as long as there's ample liquidity into the market, all the themes like AI, biotech, even Labubu, all the hard terms you can think of will dominate. Yeah. So in that sense, dividend may not be your top choice.
Then who is a dividend strategy a top choice for? I mean, who are you looking at to be really sort of driving that move or that shift?
So we talk about the mutual fund managers who always go for the growth opportunities. But they are not the real fans of the dividend names. The real fans of the dividend names are actually with so-called absolute return investors. For example, the insurance, the pension funds, or even some bank wealth management products investors. So for those investors, their risk appetite is kind of low. So they don't go for the dreams in the air, but they prefer rather something on the ground, like the 6% cash dividend that you can just pick up. So for their investors, the rationale behind is simpler. It's kind of just to compare the yield like fixed income investment. Say, for example, if you look at Alipay, the yuan yield nowadays, guess how low it is? It's just 1%, which was over 3%. So nobody can be happy about that. You've got to do something. But if you look around, the property market is off the table as well. So there's not much choice, really, for especially for the mainland investors. And the rationale for the long-term investors like insurers.
Can you tell us about fund flows, Mike? Because obviously banks have been one of the key beneficiaries of this whole dividend strategy. Are there other parts of this market where that sort of dividend strategy still works right now?
Sure. Yeah, for the fund flows, I would say definitely the pension funds, the insurers, and the southbound capitals. For example, for the southbound capital, just for this year, it has been more than 900 billion yuan. So that's a lot. So that's really still driving the case. As long as the yield is above 4 to 5, it's still like 300 plus bips spread over the T-bond. So that's going to work.
Do the opportunities look different between A and H shares?
Yes. So I would say in two senses. So comparing the yield, I would say the Hong Kong market scores, because the yield, there are a lot of names giving over 6% yield versus in China, in the Asia market is about 4 to 5. But in terms of the sector composition, the Asia actually scores because there are more and more sectors rather than the traditional financials and energy. We can see a lot of like consumer, manufacturing names coming into the high dividend paying bucket.
Okay, Mike, we're going to leave it there. Thank you. Mike Ming there, portfolio manager at eFund Management, joining us out of Shanghai. Coming up, HSBC Global Research joins us to look ahead to BYD's earnings and why they think the firm will be able to maintain market leadership in a fiercely competitive sector. This is Bloomberg.
Well, you're watching the China Show, and we've been talking. Today is absolutely a bumper day for earnings in mainland China, Hong Kong as well. But some of the highlights, of course, we've got Alibaba, we've got the banks, we've also got BYD, and you're seeing that stock here rising in anticipation of the numbers. I mean, the expectation or the prediction is that we're going to get a very robust first half set of numbers. That's after heavy discounting against some of its models that have boosted sales in turn. That's also playing out in what we're seeing in terms of the call-put ratio, because that is actually starting to rise here as well. So that tells you investors are actually getting a lot more positive about the stock, because that's the number of bullish contracts on it are outweighing the ones that are calling for price decline. So that's actually the highest level we've seen now going back to May of 2024.
All right, let's bring in Yuqian Ding, head of China Auto Research at HSBC Global Research, joining us now. We'll start with BYD. Obviously, that's the big one here, but there's signs of domestic demand is softening. Obviously, there's such fierce competition. You're still quite optimistic about the whole EV sector in general. Why is that?
Yeah, because in the first 7 months, EV still outperformed the general market. So I would say the backdrop is consumption downgrade, is weak demand. You just mentioned that. I guess the reality check is between smarter and better product, the consumer chooses the cheaper product. I guess that's the reality the market is going to face. But we would say like EV still represent the best technology, because let's say the conventional ICE models, they barely get maintained, but you will get that every month there's a lot of new EV models into the market. All the smart autonomous driving technology mostly loaded on EVs, and you simply just have more new model supply. I would also point out one interesting trend among EV is that with the increasing availability and adoption of the fast charging, basically using EV is almost on par the similar experience when you use an ICE. Let's say fast charging, 5 to 10 minutes, charge 50% of your battery capacity or 400 kilometers range. Come on, you get a coffee, probably take you 15 minutes.
Yeah, it's sort of removing that range anxiety, I guess. And actually, I think that showed up in the latest sales that we saw for Europe, and even EVs are picking up there, and that's sort of been one of the markets more behind. But BYD as well, I mean, it's had to offer discounts to entice shoppers as well. Do you see that having a bearing at all? And of course, they've got scale, so maybe they can withstand more than their competitors.
Great question. A lot of nuance happened lately. I would say the pricing situation has been changing on BYD. So in early May, we do see BYD is pushing discount, but then we see the top-down message from the government, anti-involution. So basically calling for more discipline in terms of the pricing, capacity, as well as the supply chain. We see BYD is taking the leading position in terms of doing all these discipline, no matter it's on the pricing side or on the supply chain side. They're also giving the red pocket, basically channel support in the second quarter to their dealers. So generally, we see much better price discipline in the past 2 months, especially on BYD. They have a very great channel management too. So the inventory level has been controlled within less than 2 months, less than 1.5 months threshold. So generally, I would say channel and pricing situation for BYD become much more disciplined, and they have been taking the lead to echo the anti-involution.
Can they actually lead the whole sector to do the same? Because we had a report yesterday that talked about how we haven't seen that much of a change. I mean, how difficult is it going to be to actually controlling, the behavior in a very ultra-competitive sector like EVs now, and really trying to at least stop this irrational competition?
Yeah, great point. I would say the market point. We're still in the process of the industry consolidation. Basically, industry consolidation means it has to get worse before it get better. But we did say we would say this year consolidation seems to be taking a pause. The first 7 months of this year, the EV industry top 10 market share is 77% versus 78% last year. So it's actually taking a pause here. A couple of reasons. Of course, we talked about the anti-involution. It calls for more discipline in the near term. So during the current industry consolidation taking a pause process, we do see the recent 2 months market has been focusing more on the laggers with new model cycle than the leaders. Because let's say the leaders have the existing portfolio, and if we are having the price discipline within a weak, lukewarm demand and pricing environment that seems to be limited, I could do. But as a lagger, if I have a new model, I can set the price a little bit lower. But that wouldn't count as like a disrupt the price discipline. I simply based on the market regime to set the price. So we would say against this backdrop, the laggers with more product cycle, with more new model catalyst would be better positioned.
Okay.
Just whilst we've been speaking here, we're just taking a look at CATL as well, because shares are absolutely surging. I don't know if we've got a specific reason just yet, but the most now since October 2024. So you're looking at upside of around 11% for the stock right now. Of course, CATL, it's a big supplier into the pure EV and BYD, of course, as well. But what do you think or which company do you think in the EV space, pure EV space, is faring best right now against that intense price competition?
So you were talking about cattle. So, well, are we talking about EV battery broadly, or just among the EV makers?
No, the EV makers.
The EV makers. So I would say, like, structurally, we still see BYD the consolidation winner. It's just currently we're running into the chapter that the current market setting seems to be favoring the laggers with more new car to offer, especially in the near term. So we recently upgraded Great Wall and Dongfeng. I think mostly for Great Wall, they they've got the new model coming to the market. They have another 2 model coming soon. So second half in terms of motorcycle is very strong, and we see a lot of momentum. And their overseas market, single market's weakness has been mitigated by the rest of the market growth. So all in all, with solid earnings and more model coming, we would highlight our recent action to buy on Great Wall. And also, Dongfeng, like SOE names, used to be a little bit neglected by the market. I would say the privatization and the potential EV delegate listing deal sort of make the conventional like ICE incumbency name become attractive again, at least for a near-term perspective.
What do you make of Xiaomi? You know, there's talk about entering even Europe, I think, in a few years or so. How do you think that's going to shake up the competition overseas?
Yeah, so Xiaomi is also another reason. That's why the top 10 is not consolidating, because Xiaomi is the number 11. Obviously, Xiaomi coming from nowhere, chipping away a little bit from everybody. Yeah. So I would say it is very phenomenon in the auto market, and they've been gaining a lot of traction in the domestic market. I think overseas, of course, for the broader China EV industry, is one of the strategically important mid to long term strategy, because in terms of the product, it's global competitive, although we are looking at a more complicated global trading environment. So potentially, if you localize the production, and eventually you localize your design, not every country like the big SUV, and for Europe, probably the small hatchback would be a more suitable product. And if you do that, I think all of the EV companies, including BYD and Xiaomi, are thinking strategically on that front. So if we see more traction about localization, about the global partnership, I wouldn't be surprised. That's part of the plan.
I mean, it's been really remarkable, the strength and the performance of Xiaomi so far in the EV space, and probably caught a lot of people by surprise that they've been able to do it so quickly as well. Is there anything else that you think that investors or analysts are missing in the autos market in China right now?
I would say autonomous driving. We talked about it. So 2025 seems to be the inflection year for autonomous driving. It reminds me of EV in 2020. So when a penetration breaking 10%, if you have ample supply, if you have consumer adoption, we will see the adoption curve go exponential. We're seeing the same momentum on autonomous driving. Since BYD led the democratizing autonomy in first quarter, we do see more OEM join the club to make high level of autonomy become one of the standard configuration in the new cars. So although we did talk about the consumer downtrade this year, and probably in the near term OEM have to gorge the additional BOM cost for the time being. But let's say within the city, if we're talking about the commute mode, your car driving from your parking lot to your office parking lot, the whole process hands off for the whole week. That's the experience that's going to be inflected in the coming 12 to 18 months. So if you have that kind of function, the consumer's payment intention will go up from there. We see potential better revenue opportunity. I do want to highlight that, because that's one of the most important keywords of the sector among EV. That is autonomous driving. That's predominant the second half of the debate.
Okay. I can't even wrap my head around that.
I love that idea.
That no one's gonna be driving me.
Regulators will need to catch up though, you know, because you've got to have the regulations.
We don't live in China. That's why we live in Hong Kong.
Of course, the regulators are also doing their job. They're ramping up their framework on that. But let's say it's the same thing. So the regulator is playing catching up the technology, while at the same point is keep breaking out and provide you basically hustle-less driving. No driving experience.
Oh. Fascinating stuff. All right, Yuqian, thank you, Yuqian. There, Yuqian Ding, head of China Auto Research at HSBC Global Research. We got plenty more ahead. This is Bloomberg.
Taking a look at markets this morning, and we're actually seeing Chinese equities that are in the green so far today. Yesterday was a really interesting session because we really saw that preference for A shares starting to build at the expense of H shares, of course. But today in the session, I mean, there's really a lot to watch on the docket. You've got earnings, of course. We can't say enough. Alibaba is coming up. BYD is coming up. We've got PMI figures over the weekend as well, plus the Fed's preferred inflation gauge later today.
Yeah, it's really kind of regained some mojo here right now, but particularly when it comes to Hong Kong. We're at 1% right now. HS Tech has also up some 1%. Maybe Alibaba could be the big catalyst next. But certainly this whole momentum behind this equity rally continues, and maybe that's why Goldman Sachs decided to raise their price targets for the CSI 300 as well. That's it for us here on the China Show. Insight with Haslinda Amin is next. Stay with us.